From a trader standpoint, I think that gold's probably going back to 3,000. Okay. We talked about last time we talked, I said it would get to 3,500. It did. I thought silver would get close to 40. It did. I think they're both going to pull back a little bit, but again, if you're an investor, you should be buying it and holding it and putting it away and not worrying about what it does day to day. It's just consolidating right now. I could see silver at 40 this year. I think there's an outside crack that could try to make a run at 50, depending on how it plays out in the markets and depending on what happens everywhere else. But we could see another squeeze there as well. And I think there's an outside chance. I say 40, I'm pretty confident we see before the end of the year. I think there's an outside shot at 50.
Todd Bubba Horwitz, a veteran trader and strategist at BubbaTrading.com, says he prefers being short-term bearish but remains committed to holding physical metals, which he doesn't plan to sell. The gold market is experiencing notable volatility, with prices dropping to around $3,330 per ounce on Tuesday amid hopes for potential trade deals that could reduce demand for the safe haven metal. While trading gold, Horwitz sees it pulling back to $3,000, though his long-term view remains bullish. This near-term caution contrasts sharply with the longer-term institutional outlook. Citi's global commodity team, however, thinks this demand has peaked and the price will weaken materially by the second half of 2026. Its quarterly market outlook predicts that the gold price will drop to the $2,500 to $2,700 range by the end of next year. The current market environment represents a significant shift from the sustained rally that has characterized the precious metals market for an extended period. While prices have been rising for 2 decades, the rally became supercharged during the pandemic due to a multitude of factors. Investors sought to hedge against fiat currency debasement and inflation, while central banks sought to diversify their reserves. In the silver market, Horwitz maintains a distinctly optimistic stance. Todd Horwitz believes silver is currently consolidating but has substantial upside potential. He confidently expects silver to reach $40 by year-end and sees a possible move toward $50, depending on broader market developments and potential short squeezes. Before we begin, please take a moment to like and share the video. Subscribe and enable the notification bell to stay up to date. Your support is what keeps this community growing stronger every day.
Well, right at the moment, I would rather be short than long. Okay, right at the moment. But again, I'm a big fan. I'm an owner. So let's be clear. When I'm talking about long or short, I own physical metals and I'm not selling them. Okay. But there's times I may have a partial short position as a trade. From a trader standpoint, I think that gold's probably going back to 3,000. Okay. We talked about last time we talked, I said it would get to 3,500. It did. I thought silver would get close to 40. It did. I think they're both going to pull back a little bit. But again, if you're an investor, you should be buying it and holding it and putting it away and not worrying about what it does day to day. Too many people worry about markets on a day-to-day basis versus what is the long-term view. We know the central banks and the Federal Reserve is buying gold because they're trying to protect the currency, which is failing. So again, it's a hedge against inflation. Physical metals are terrific to own. From a trading standpoint, I think they have some room to go on the downside, but I certainly would either, if I was trading them, I'd either short them or wait for an opportunity to buy. But physical metals, I think you can buy anything. That I'm always 100% invested in the stock market, right? I mean, I would say, let's say if you want to break it down, I'm 80% stocks, 20% metals. Okay. I don't sell. I continue to buy. There's ways to hedge your portfolio. And there's an old saying, an old adage, it's not timing the market, it's time in the market. Because over time, just like gold and silver, they've gone up over time. The stock market has gone up 8.5% and since the day in history it started. So think about that in real terms. If you're always invested, okay, you're going to make money over time. That's why you have to invest with money that you have that you can afford and don't have to look at it every single day. Okay, people are looking at their 401ks and IRAs every day like they're going to sell them. You cannot invest like that because you'll give yourself a nervous breakdown. It vacillated between 27 and 2,800 and suddenly bang, it was 3,500. So again, you have to be prepared for those things to happen. But if you're not liquid when those times happen, if you're trying to trade as an investor back and forth and time the market, you're never going to be able to do so. And I think the metals are great. I do expect a little bit of a pullback. But again, I welcome pullbacks because those are buying opportunities for me. And I want to be able to be a buyer, which is why you always need to have a little bit on the side. And again, you can't overinvest and you can't over leverage because if you do, then you're going to be forced to make a bad decision. And I think that's what too many investors do is they get over leveraged and then they make a bad decision. Very similar to what the government's going to have to do eventually, and very similar to what the banks did in 2008. They got over leveraged, they had to make a bad decision. Unfortunately, they had the taxpayers to bail them out, but the bottom line is they made a bad decision. Based on history, I would say platinum eventually will go over gold. How will it happen? Will gold fall and platinum rise, or will platinum just accelerate? Remember, platinum is a lot less liquid as a product than gold, so it has a potential to explode past gold. If you go back to 2009 when silver went to $49, that was because of lack of liquidity, not for any other reason. And the same thing could happen in the platinum market because there isn't as much liquidity in platinum. So you could get it could overtake gold, but certainly now we're 2,000 points away. So it's not like I'm thinking it's going to happen tomorrow. It's just consolidating right now. I could see silver at 40 this year. I think there's an outside crack that could try to make a run at 50, depending on how it plays out in the markets and depending on what happens everywhere else. But we could see another squeeze there as well. And I think there's an outside chance. I say 40, I'm pretty confident we see before the end of the year. I think there's an outside shot at 50.
Gold and silver have maintained their status as premier investment assets for thousands of years, offering unique benefits that attract investors seeking both stability and growth. Their enduring appeal stems from fundamental characteristics that set them apart from other asset classes. In times of uncertainty, gold and silver continue to play a vital role in preserving and building wealth. Gold is prized for its long-term stability and safe haven status, while silver offers additional upside due to its strong industrial demand and growing investment appeal. Together, they provide a balanced approach for investors seeking to preserve value and capitalize on future opportunities in an evolving market landscape. Could silver be gearing up for its next major breakout in the metals market? Share your thoughts in the comments. If you found this video helpful, give it a like, share it with others, subscribe to stay informed with the latest market insights. Your support helps us grow.
That tells you that we're in a recession, Elijah. That tells you that the little guy is hurting very poor badly here. The middle class is in trouble. They're not allowed, they don't have money to buy gold. Many of them have given up on their 401ks because they can't, and they're giving up 4% of their own income because they can't afford to support it because of the high inflation. So that's what's going on here. And this is once again, you hear it all the time. The rich get richer because they can take care of opportunity. So they're buying at a low premium. Price is high. So what? They're buying at a low premium to spot and they're happy to store it and hold it because they can afford to do so. And I think that's something that you have to understand as a trader, as an investor, and as a person, that it's very important that you always take care of yourself first and you make sure that you've got assets that you can put away. You need to, just like the government has to balance your budget, you as a person have to balance your own budget so that you can have money put away so that you have gold and you have silver that grows in time. I would think that, listen, everybody's plan and goal should be is to stockpile as many assets as they can and not have to spend the money. Because typically, when people have to sell an asset that they own, they're usually selling them on sale, right? They're usually selling them under distress, which means if they're under distress, more people are under distress, which causes market collapses. That's why I say that you need to be able to put money aside and make sure you have assets on the side so that you don't have to sell them, especially in times of distress. When you want to sell when the markets are strong, if you want to get out. You don't want to sell when the markets are weak. That's the most common flaw for investors, is they panic when the markets get weak, when that's actually a buying opportunity, which is why the wealthiest 1% or 10% continue to get wealthier, because they buy when the markets go down, knowing the strength of the underlying market is always still there. Well, the banks are still stealing from the public. I mean, let's face facts, right? The federal funds rate has come down 100 basis points. The 10-year notes have gone up 100 basis points. That says that the banks are making 200 basis points. The public is not seeing the savings. Mortgage rates are high. They're 7%. So again, at the end of the day, the banks are making the money. They're printing the money. They're putting the money out in the street. and yet interest rates keep going up. It doesn't make a lot of sense, does it? When you think about it. So again, the banks are in trouble. They're well over leveraged, in my opinion. Again, these are just my opinion. They're well over leveraged. I believe that you're going to see something very similar to what we saw in '08. And I think we're getting very close to it now. You can kind of see it by the lack of volume, the retail rally, the way that they're holding up on interest rates, and it's still not enough. And you still have people fighting for lower rates, which again does not benefit the consumer. It only benefits the bank.
The middle class.
It's going to turn into stagflation probably. Okay, this is the problem that has been created by the banking system, by the fractional banking, by them allowing to lend what they lend and then overlend. This is caused by our government that continues to overspend, okay, which has to create inflation. I'll give you the best example I can give you, Elijah. 1985, the average income was $25,000 a year. The average house was $80,000. So it's just over 3 times. Today, the average income is $70,000. The average house is $500,000, over 7.5 times. You tell me who's making that much more money, okay? 7 times versus 3 times. They're not. That's the problem. Okay. And when you have a government that continues to spend and spend and spend because they know that the taxpayer is going to pay, okay, and you allow the banks to create new money, which is what they do. Again, when you can lend out 10 times what your reserve is, and it's not even their reserve because they can take the money they borrow from the federal funds, take that liability, turn it into an asset, and then lend out 10 times that amount. So all they're doing is printing new money. Okay. It's a whole catastrophe, which is going to once again shock the world at some point. And of course, we'll rebuild and they'll figure out a way to fix it. Because again, if the banks and the stock market actually really fail, and I mean really fail, then we got a lot bigger problems.
Gold and silver have maintained their status as premier investment assets for thousands of years, offering unique benefits that attract investors seeking both stability and growth. Their enduring appeal stems from fundamental characteristics that set them apart from other asset classes. In times of uncertainty, gold and silver continue to play a vital role in preserving and building wealth. Gold is prized for its long-term stability and safe haven status, while silver offers additional upside due to its strong industrial demand and growing investment appeal. Together, they provide a balanced approach for investors seeking to preserve value and capitalize on future opportunities in an evolving market landscape. If you found this video helpful, give it a like, share it with others, subscribe to stay informed with the latest market insights. Your support helps us grow.